Here's how people are reducing their tax liability to zero by buying real estate. Now, there are three caveats to this. It does have to be a short-term rental, it does have to be managed by you, and you do have to spend 720 hours a year managing it. Now, for this example, we're gonna buy a $500,000 short-term rental, and we're gonna have to bring in $100,000 to put 20% down. Now, generally speaking, you would be able to depreciate this asset over 27 and a half years per the tax code, which equates to about 3.6% of the home value each year against the income the property produces. And that generally does not pass through, that write-off does not pass through to your W-2 income. Now, the unique part about a short-term rental is that rather than write this off over the next 27 and a half years, it allows you to 100% depreciate the asset in year one. Now, let's say, for instance, you make a household income of $500,000. Well, by purchasing this real estate, you've spent $100,000, but you've reduced your taxable income by $500,000. So you would have otherwise paid the government roughly $140,000 in federal income tax. Now, you're not going to get 100% of that back, but you are going to get a large majority of it back. Well, guess what? You'll get enough back to actually make the down payment on your next $500,000 property. And you could do that next year to offset your taxes for that year. Now, the great part is that this carries over. So if you were to purchase a $1 million property and you had a $500,000 gross or net income for your household, you would be able to write that asset off for the next 2 years to reduce your tax liability. So as always, the devil is in the details because, as I said, we depreciated that asset 100%, meaning we took 27 and a half years worth of deductions all in year one. Now, if you were to sell that home in 7 and a half years, that means that you still took deductions for 20 additional years that you actually didn't own the property. And the government did not forget about that sweet little tax break you got. So what they're going to do is called depreciation recapture, okay? So we are able to write off $18,000 per year. There is 20 years that you have taken deductions that you did not own the property. They are going to take 18,000 times 20, so $360,000, and they're going to add that directly to your taxable income for that year, and they're going to charge you taxes on it. So you would have to actually own the property for 27 and a half years to experience that. Now, you do not have to take full depreciation all on year one. You can take 5 years worth of depreciation, 6, 7, 8. So it doesn't all have to be a 100% depreciation. So like many of these other opportunities, it is a great way to reduce your tax liability when done correctly.